Hello there. My name is Roger Gitonga, an expert tutor of tax and audit, and I'll be taking you through this mock debrief section A. I do hope that it will really, appreciate or make you appreciate what you could actually do to get the easy marks. And at the same time, probably, go for the areas that you're probably struggling with. But I'd like to add a disclaimer. We won't do all the questions in section A, but we will be touching on all the questions in both section B and C. So let's dive into this and let's see what we could do in section A that would have helped us to score the marks we required. Now, I'm going to start off with question 1. Now, as you can see here, I love to really read the scenario first, and I mean the requirement, the part in bold. And it says select whether Breeze Limited and Gale Limited would be part of a group relief group and or a chargeable gains group with Zephyr Limited by clicking on one of the relevant boxes below. So the first thing that I really want to understand is my knowledge around this two areas, both the chargeable gains group and the group relief group as it is called. We also call it the 75% group. Now, we're told here Zephyr Limited holds 80% of the ordinary share capital of Quiver Limited and 60% of the ordinary share capital of Gale Limited. And Quiver Limited holds 85% of the ordinary share capital of Breeze Limited. Now, we need to note our focus is on Gale and on Breeze in this case. So first and foremost, for the group relief, you should have at least 75% direct interest and 75% effective or indirect interest. We will be measuring this for specifically Breeze because Breeze is what I like to describe as a sub-subsidiary. Simply the subsidiary of your subsidiary. Or if you're to think about it in a family structure, think of your subsidiary like your child and the sub-subsidiary like your grandchild. So we're basically, assessing Breeze as the quote-unquote grandchild of Zephyr. Now, we also have here the chargeable gains group, and this is normally 75% direct interest and 50% effective interest. Now, looking at these statistics, it can be easy for us to identify where, for instance, let's say Gale sits. Now, Gale, as you can see here, is a subsidiary of Zephyr, but Zephyr has a direct interest of 60% in Gale. It seems like Gale will not fit in any of the two kinds of groups. I don't know if you can see that. But then when it comes to Breeze, it's a bit different because Breeze is a subsidiary of Zephyr. So we find here in Breeze, Zephyr has an effective interest of 68%. Now we get that by multiplying both the direct interest Zephyr has on Quiver and the direct interest that Quiver has on Breeze. So we take 80% times 85% and we get there 68. Now we can see here the effective interest is greater than 50% for the chargeable gains group, but it will not qualify for the group relief. Of course, for Gale, we only have 60% direct interest. Now, that would primarily mean that for Breeze, the chargeable gains group will qualify, and for Gale, neither will fit in. The second thing we have here is on question 3. And I love to read what the question asks you for. It says, what is the annual allowance charge that will be added to Lucy's taxable income? So our primary focus is on the annual allowance charge and not necessarily on a taxable income. Sometimes a student could read what they want and start to compute computations that are not required. You might find someone deducting personal allowance because they saw the term taxable income, and yet the question is simply asking you for the annual allowance charge. So when you're reading the requirement, be very careful to capture exactly what we're looking for. This could really save you quite a few marks and mistakes as well. All right, so it's just good to note that. Now, you're told here Lucy made a gross personal pension contribution of 85,000 for the current tax year, but her adjusted income is 290,000 and she has no unused annual allowance brought forward. Now, we can see here I have opened the tax table, then I have specifically focused on the pension scheme limits. My great focus will be the annual allowance in the current year because there's no brought forward annual allowance. And I can see here for the current year 2024-2025, my annual allowance is 60,000. But there's an income limit, and this income limit occurs when your adjusted income is greater than 260. Now, in our case, our adjusted income is 290. So we've exceeded this limit. Now, what does that necessarily mean? It simply means that we now need to reduce our annual allowance. How do we do that? Well, we first find the excess of how much we've exceeded the limit, and we get 30,000. And then we take half of that excess. So you take half of 30,000, you get 15K. And that 15,000 is then deducted from the annual allowance of 60,000 to give you your adjusted allowance of 45,000. So we are now working on using the annual allowance of 45,000 because it has been reduced and not 60,000. I think it's important for us to also note that the minimum allowance you can actually have is 10,000. So if you were doing another question and for instance, the adjusted income was way higher than this, let's say about 330,000, there's a high chance you might find your annual allowance could be reduced to a very low figure. But in such a case, you might want to appreciate, or let's say 400,000, but you want to appreciate that in such a case, we cannot reduce your annual allowance to less than 10,000. Okay, so it's just good to note that. But anyway, let's come back to the question. So remember, Lucy has made a contribution of 85,000. Okay, she has an annual allowance. So the annual allowance is simply giving you a chance to be able to contribute up to a certain amount without being taxed. Okay, but as you can see here, our annual allowance is 45,000. So Lucy could have been able to contribute up to 45,000 without being taxed. But since she contributed 45,000, you realize that, 85,000, sorry, we realize that she's contributed an excess of 40,000 and that 40,000 will be charged. So she will be taxed on that 40,000. Now, I'd also like us to understand that as much as, and this is just a by the way, but as much as, she's contributed 85,000 to her pension contribution, it's good to note that in another question, this personal pension contribution would have expanded the band rates. And this would be very helpful when you're computing your tax liability. All right. And it also helps you in other instances. So gross personal pension contributions help you in computing your adjusted net income as well, specifically for the purposes of determining your personal allowance and your child benefits. Okay, but that's just a side note. But this is how we would get our answer, and our answer would be 40,000, as you can see there. Then we come to question 5. Now, again, the question is asking us here of Vlad's payment on account for the current tax year. Now, payments on accounts are usually determined by the relevant amount of the previous year. Now, as you can see here, we are focusing on the tax year 2024-2025. The relevant amount is usually the income tax amount and the class 4 NICs of the previous year. And then we take 50% of that relevant amount, and that becomes our first payment on account and our second payment on account. So this is exactly what we do. We take our income tax plus our class 4 NICs, which is 10,670, and we take 50% of that relevant amount, which will then help us to determine our payment on account. Okay, so our answer is 5,335. Knowledge is very powerful. So if you know what to do, it's very easy to sometimes get some very good, easy marks in your exam. Now, we have this other question that focuses on us getting your capital gains tax liability. It's important for us to understand how we get our CGT normally. Now, if you look at this question on way, they're giving you the employment income. Now, we know for a fact that when you're dealing with capital gains tax liability, we usually use your taxable income to determine the rate you're going to apply on your taxable gain. So this employment income, we should be able to get the taxable income first, where we're going to deduct personal allowance. And for the chargeable gain, you have to be very careful sometimes with the wordings that are used, because you can see here, they're using chargeable gain. We need to get our taxable gain. And we do that by deducting our annual exempt amount, okay, of 3,000. So we have two things we have to first determine. One, the taxable income, and two, the taxable gain. So I get that. I get my taxable income, which is the deduction after you deduct your personal allowance, and you get 34,430. And you get your taxable gain, where you deduct the annual exempt amount of 3,000. Now, as you can see here on the first line, our taxable income is below the basic rate limit. Please note, we don't tax the taxable income when we're getting CGT. We tax the taxable gain. Now, the taxable income is only used to help you determine the rate you're going to apply on your taxable gain. I hope that makes sense, right? So you find in our case, our taxable income is less than our basic rate limit. So normally what we would do is we would then add the taxable income and the taxable gain to see if the summation of the two figures is either less than the basic rate limit or higher. Now, allow me to say this. If our taxable income was greater than the basic rate limit, would directly apply the higher rate of 20% on the taxable gain. Okay? Now, as well, if the addition of the two was below the basic rate limit, let's say we added, this was 30,000 as opposed to 34,430, and 5,500 remains the same. If you find that the summation is below the basic rate limit, you would multiply the taxable gain, the lower rate of 10%. Okay. Now, in our case, none of the two that I have stated is the case here. So we add the two and we realize that the summation of the two is actually greater than the basic rate limit. So what do we then do in such a case? We take the the basic rate limit, and we less it by the taxable income, and we multiply the difference by 10%. Now, we then take the excess. Remember, the summation of the two gives you 39,930. So you take the excess minus the basic rate limit times 20%. Now, I want to show you something very interesting to just test if your answer was correct. Look at what I have deducted in the brackets. Okay, if you take here 37,000, let's say 700, for instance, all right, and I end up taking 34,430 as you get there, you will notice that your answer would be 3,270. Okay, just what you have in the brackets. And then imagine taking out your 39,930 minus 37,700. You'll get 2,230. Now, if you add the two differences where you have 3,270 plus 2,230, you should arrive at the amount of 5,500, which then shows you have clearly been able to multiply your taxable gains to get your CGT appropriately well. All right. So that's one of the litmus tests, or one of the tests you can do when you want to confirm if you've done the right thing. Then we come to question 8. As you can see, I'm not doing all the questions, but I did try to select the questions that are touching on different areas so that we don't incline only to one area. Now you're told here, from what date will Damien have to charge output VAT on his sales? Now this is a matter of registration. So we go to our tax tables and we notice that the registration limit is 90,000. So if their sales exceed 90,000, then they would have to register for VAT, and hence they will charge output VAT on their sales. Now, I'd also want us to note something here that's very important. While you're doing this, notice this. we're told here he started his business on 1st of July. His sales exclusive were 9,000 for the first 3 months. So we take the first 3 months, 9,000 times 3, we get 27,000. We're told for the next 3 months, his sales increased to 10,000. So again, for the next 3 months from October, November, and December, we take, the 3 months, we get 30,000. I can see already we've not yet exceeded the 90,000 yet. We're at 57,000. So we're now trying to see which month do we exceed the 90,000 limit? So I take January, I take February, I take March, and I realize it's in the month of March that when I look at the addition of all sales from July to March, it's on the month of March that we exceeded the 90,000 limit. So HMRC then gives you about 30 days, to notify them of this occurrence, and then they will register you from the first of the month that follows, which in our case is 1st of May. I could immediately know 30th of March is wrong because it's not at the beginning. Registration always happens on the first of a month. All right. So that would, especially when you're using the historical registry, the history test, you do appreciate that this would be the first of a month. Okay, and therefore, I would automatically have removed A and try to debate around the other three if you are not sure of what to do. Now, here's another question that I find intriguing. This is question 12. You're told, what is the maximum residence nil rate band that can be claimed at the time of Jake and Amy's death, respectively? Now, the resident nil rate band usually has one particular trick for me. And I'm going to tell you exactly which one because we see it in this question. First and foremost, a lot of students struggle with the concept that we have something known as transferable residence nil rate band. And transferable residence nil rate band works very interestingly because you transfer from the spouse that died. Okay, so for in this case, Jake died before Amy. All right, but you find Jake might not enjoy the residence nil rate band because he died on the 18th of November 2014. By this date, the residence nil rate band was not available by law. Okay, but then you find when it comes to Amy, she might qualify for this residence nil rate band. Why? One, she died after it was already drafted as a law. I mean, it's already in place. It's operational. But secondly, part of her estate includes her main residence, and this is given to a direct descendant, which is her daughter. Okay, so she qualifies for residence nil rate band, and that means she'd have her own 150,000. Now, let me say this. 175,000, sorry. Let me say this. I can already see option 1 is the answer because Jake is not entitled and it's the only answer that has 0. So that would have automatically helped you to choose your answer and moved on, even if you're not so sure how to get the 350. Okay, but then let's try and remember the residence nil rate band is 175,000. You do not want to confuse it with the nil rate band. Now, the part that's usually tricky is the fact that you can transfer from Jake, a residence nil rate band, which he didn't even have, to Amy and add it on to her own residence nil rate band. So if Amy had 175,000 applicable, she can also transfer from her husband, her dead husband, Jake, so that the total becomes what she's entitled to. So you'll now have 350,000. But I'd like us to note this. If it doesn't matter if Jake did not qualify for the residence nil rate band, what matters in the operation of this relief is whether Amy qualified for it. So if Amy qualified for it, then we consider it. And that's why we considered it over here. Okay, I hope that makes sense. All right. Now, I know sometimes it doesn't hit home for a lot of students because you're thinking, but Jake didn't get it. And that's true. But Amy has the privilege of actually enjoying a higher resident, well, not her, because she's also dead, but her beneficiaries have the advantage of actually having a higher residence nil rate band, which means that they can tax higher amounts at 0, which is a good thing. Now, in other questions, if we were given the value of the residence, would be able to take the lower of 350,000 and the value of the residence minus any deductible mortgages. But we're not told of the value of the residence, nor are we given any deductible mortgages. So we only take the 350,000. And therefore our answer is option 1. So that's the end of section A. Let's jump into section B.